In section 14-3, we're going to be talking about the concept of a promissory note. So a promissory note is a written and signed promise to pay a sum of money. So we're going to use a promissory note when we have decided that the accounts receivable account is never going to be collected. But unlike in 14-2 where we just wrote off the account, that was for a smaller amount. For Edmonds Hospital, $639. An amount that wasn't as big of a deal to write off. Well, we're going to use a promissory note when it's a larger amount that a company owes us, and we cannot afford to just write it off. So instead, we are going to use something called notes receivable. So a note receivable is similar to accounts receivable, except for now we're going to be charging that individual interest. So the person or the business that signs a note promising to pay, they are called the maker of the note. And notes receivable and notes payable, the same concept as accounts receivable and accounts payable, just that it is not as common. So the payee is the person that is going to be receiving the money. So in our situation, it would be 3 Green Services. Principal is the total amount owed. Then we're going to charge an interest rate. So an interest rate is just like an interest rate if you had purchased a car or a vehicle, it's a percent. Maturity date we will be calculating. If the maturity date is 90 days, then we will calculate, so the time of note would be 90 days, and we'll calculate the actual date. Maybe it's June 30th or whatever it may be. So this is a promissory note. They are going to all be numbered. It'll have the date. We're giving Skinner College 90 days to pay us, 3 Green Products, the payee. The principal is the total amount they owe us. We're going to charge them 8%. The maturity date would be June 16th, signed by Skinner College, and then also signed by a witness holding Skinner College to this agreement. So we're moving money out of accounts receivable into notes receivable. So we're going to increase notes receivable with a debit and decrease accounts receivable. We're taking it out of accounts receivable because we're never going to get it and putting it into notes receivable. So the total amount there, $2,578.35 out of accounts receivable into notes receivable. So the journal entry would look like this. Now notice we didn't do anything with the days or the interest rate. That's what we're going to look at next. Right now, when we accept the note, we just move it from accounts receivable to notes receivable. So interest, that's the amount that you charge someone for borrowing money for a period of time. So to calculate how much interest we actually charge someone, we first need to take the principal times the interest rate, and then times the time. So our book uses the time as a fraction of a year. Now we know that there's 365 days in a year. The book uses 360 to make the math easier. So 90 over 360, that'd be 25%. So 2,578.35 times 8% times 25% gives us $51.57. That's the interest we're going to charge Skinner College. So they owe us principal plus interest, which is called the maturity value. So we need to collect now $2,629.92. To calculate the due date, so it's a 90-day note. So 90 days, we need to calculate. So we started on March 18th. So in the month of March, 13 days, leaving us with 77 days left of the note, 90 minus 13. Then April has 30 days, so 77 minus 30. Now we have 47 days left. 31 days in May, 47 minus 31, we have 16. 16 days remaining, so June 16th would be our due date. Interest income, this is another new account that we have. So after we've reached the maturity date, they pay us. They're going to pay us the principal and the interest. Interest is like revenue, like sales. This is money that we're earning. So when they actually pay us, so Skinner College pays us, we receive cash, so we're in the cash receipts journal, and we're going to debit cash, and we're going to decrease notes receivable with a credit, and increase our revenue account with a credit. Just like we only credit sales, we're only going to credit our interest income when we receive that money, $51.57. Principal plus interest gives us the total cash we're receiving, and it will look like this in our cash receipts journal. Finally, we have the scenario where even though they wouldn't pay accounts receivable, so we move it to notes receivable. We give them 90 more days to pay, and we're charging them interest. It's still possible that they might not pay. This is called a dishonored note. So recording a dishonored note receivable, now we need to put that money that we put into notes receivable, we need to take it back out, put it into accounts receivable, plus interest. So we're adding $3,040 to accounts receivable, taking $3,000 out of notes receivable. We need to credit the interest income. So a total of $3,040 debit to accounts receivable Stout Company. And the transaction would look like this. This would be the opposite of the very first transaction we did, where we took money out of accounts receivable and put it into notes receivable. Now we have to take it out of notes receivable, put it back into accounts receivable because they still owe us that money. Then we would have to write off their account like we learned in 14-2. And that is section 14-3, where we use notes receivable, charge companies interest, and give them additional time to pay.